After a difficult year for traders and investors in the stock market in 2023, investors are faced with forecasts for lower but more prolonged increases in interest rates by the central banks, a weakening of the dollar and a slowdown in global growth. Central banks around the world, led by the US Federal Reserve, responded to inflation by aggressively raising interest rates, which in turn challenged interest rate-sensitive growth stocks throughout most of the year. This trend does not apply to the cyber sector, which enjoys a strong net inflow of funds. After the supply of Russian gas through Nord Stream 1 was shut off, the energy crisis in Europe led to a substantial shift in the region's priorities for economic development and national security in terms of climate change. Global inflation is expected to drop sharply against a weaker fundamental effects, resulting from a drop in oil and gas prices at the same time as a global economic slowdown. Easing of the corona restrictions, rescue plan for the real estate market and easier policy from the Chinese central bank helped stocks that were evaluated at attractive value to recover towards the end of 2022. Sectors that expected to outperform in 2023 include technology, that leads by electric vehicles and e-commerce. In addition, China's reopening, combined with large public investments in clean energy, may support demand for commodities such as uranium, lithium, cobalt, and nickel. Despite the economic and geopolitical risks, there are trends that will remain intact for several important sectors, such as metals, related to technological innovation, clean energy, and Chinese economic expansion.